So good afternoon, everyone. Welcome again to our panel on financing electrification. It's tough to follow Tom, but the team's going to do its best, and we hope to provide you, as Lawrence mentioned, several insights into how, as an industry, we are working to mitigate risks while maximizing opportunities. As introduced, I'm Calvin Butler, CEO of Baltimore Gas and Electric. For those of you who don't know, we are the largest utility in the state of Maryland and the first gas utility in the nation, and also part of Exelon Company, a holding company of multiple utilities and nuclear plants, and Constellation Energy, a retail giant headquartered in Chicago. I've had the pleasure of being CEO of BGE for 5 years, and even in this relatively brief period, we've experienced shifts that have brought by advances in technologies like electric vehicles and battery storage, and also through evolving customer expectations. This brings new challenges, as we just heard, and opportunities, which we are all well aware of, but have been wrestling with as an industry. But today, we get to hear from a different perspective, as we have brought together a panel from the finance world. We're joined by, as Lawrence indicated, and I'll ask them to raise their hand, identify which one they are, Anthony Hadley, VP Global Infrastructure Equity from AMP Capital Investors. Anthony, thank you for being here. Joseph Savage, Vice Chairman, Global Head of Power from Citi. And last but not least, Carolyn Campbell, General Counsel and Managing Director, Emerging Capital Partners. So again, welcome, and thank you for taking the time to share your insights. We're all eager to hear your perspectives on the future investment landscape for our industry, including how electric companies can continue to raise capital, invest for growth, and deliver value in an increasing complex and competitive environment. So this is so important now as energy systems are rapidly changing. Widespread transportation electrification is on the horizon, and the reduction of carbon impacts become more imperative. In fact, the International Energy Agency forecasts that electricity will account for more than 40% of global final energy consumption by 2050. This growth may require as much as 100 trillion with a T, dollars in cumulative investment. Across the globe, electric companies are leading the transition to more environmentally sustainable, operationally resilient, and technologically advanced electric power systems. And we'll need our partners in finance to help us get there. We'll start by hearing some introductory remarks from each of our panelists and then get into our questions. Also, there will be time for your questions at the end of the session, so keep those in mind. And Carolyn, we'll kick it off with you.
Great. Is this on?
It is.
Okay, great. So hello, I'm Carolyn Campbell. I am one of the founders and a partner of a group that's invested exclusively in Africa since 2000. We're on our 5th flagship fund. We invest across the continent in the Anglophone and Francophone portions of that continent, and we've raised over $3.5 billion for this purpose. We've made 66 investments and exited 45 of our companies and done listings and buybacks and all sorts of exciting things. And I believe the reason why Lawrence invited me here today is that one of our most exciting investments is in a electric and water utility company that has assets in Senegal, water distribution assets, and electricity production and distribution assets, and water distribution assets in Ivory Coast. It's called Aeronove, and it has grown to 1,250 megawatts. 300 megawatts of which we've added since we invested in 2008, with 400 more on the horizon. The exciting thing about this investment is that we saw it as a way to change how this sector was looked at in Africa, both from the perspective of the technical expertise and the financing. On the technical side, we decided that the most exciting aspect of this was the pool of local engineering and technical and talent. So we didn't look for expats. We wanted to be based on local a local foundation in that regard, and we identified the group. So this was one of the first pioneering management buyouts in the region. The second thing we wanted to do was progress the capital base. So, of course, we had quite a bit of money and we could do that. But alongside us came local pension funds, and a significant portion came from the management themselves. We did lend it. We had a facility that allowed a stock option plan to be created. But they're very invested. And the exciting thing is that we've lived through a lot in 10 years together. There has been a civil war and a coup d'etat, and we've really had a very good experience. The company continues to grow, connections continue to grow. There's a pipeline of projects in renewables and non-renewables. I may get to that later. But the thesis has really proved up, because what does it mean? It means it's a cheaper company to operate. It means that our tariffs don't have to match, sort of be some blended combination of world rates and local rates. They're by definition going to be less expensive, and we've managed to work very closely with the local governments, which is a key to operating in a sustainable fashion, for the long haul in the region. We previously used technical partners from Europe, but I'm sure I don't have to tell you all in the room that the commitment of some of the partners to what we're doing in Africa tends to be at the whim of their international strategies. And to use an analogy, it's like viewed as a contracting business, and you do a lot of change orders. But think of the number of changes of international strategy of some of the world's biggest electricity companies, and we didn't want to have that experience be the norm for Africa. So that's my backstory.
So, Carol, let me make sure. Regime changes and civil war is good for business.
If your business is solid and it's well structured,
all right,
you're going to get through it fine.
Okay.
We operated to the dime practically the year after, so it was great.
All right.
Yeah.
Just messing with you.
It's not good for business. No.
All right. Anthony, please.
Sure. Thank you, Cal. Is that up? Flip it up. Yeah, that's right. Is that working? Yes. Thank you. So yeah, look, as Calvin mentioned, my name's Anthony Hadley. I'm a Vice President in the Infrastructure Equity Division of AMP Capital. Originally started my career as an electrical engineer advising utilities businesses in Australia before I moved across to M&A advisory and ultimately onto infrastructure private equity at AMP Capital. Now, for those in the audience that are less familiar with AMP Capital, we are a specialist investment manager. We currently manage over $130 billion in AUM globally. That's across a range of asset classes such as equities, fixed income, property, and infrastructure. And within the infrastructure private equity division where I sit, we manage around $13 billion in assets globally, and we invest that across 4 key target sector verticals. So those verticals are transportation, communications infrastructure, social infrastructure and health, and last but not least, power and utilities. Within our power and utilities investment portfolio, I would sort of characterise it as we have a broad investment portfolio which ranges from more traditional assets in the asset class, which include Endeavour Energy down in Australia and Powerco, both distribution, electricity regulated utilities, to more what I sort of call growth platforms, which would include a joint venture that we closed last year here in North America with Invenergy Clean Power, one of the leading IPPs in the space over here, along to what I'd call, I think, more of a sort of disruptive type business and a leading edge technology business. And that's a business by the name of Evergen that we have a VC investment in that is essentially a rooftop solar and behind the meter energy storage platform that targets the residential markets down in Australia. So look, I think the topic of today's panel, which is mitigating risk and maximising opportunity, really resonates with me because I think it very neatly sums up the lens that we try and look through in terms of how we think about investments in the infrastructure private equity world. In terms of mitigating risk, we look for businesses that exhibit infrastructure characteristics and provide essential services. We look for businesses with strong downside protection and barriers to entry. We look to mitigate risk through portfolio diversification. And most importantly, we look to invest in companies and sectors that we feel we have some existing knowledge, experience, or some form of unique angle. In terms of maximising opportunity, we increasingly look for businesses that we think lend themselves to a value-add asset management approach. We look to take control and interest in our investments wherever possible so that we can really dictate and drive business strategy and business outcomes. And we're increasingly looking to invest in platforms for growth. So look, what does all this mean in terms of our views on the investment landscape for the power and utilities sector going forward? I think it's really important to emphasise and reiterate that this is obviously a sector going through tremendous change and transformation right now. I think that as an investor, AMP Capital, we look to participate and get exposure to that changing dynamics within the parameters that I mentioned around that aim to mitigate risk and maximise opportunity. And I think through that lens, there's a few sort of key themes that I think that we're seeing that are shaping our investment strategy today and that we think will continue to shape the trends in the industry over the medium to long term. And those themes are this. Firstly, there's a very significant transition away and migration from coal-fired power stations and generation to lower emission resources, namely gas in some instances and renewables. The second theme that we're seeing is that we feel that battery storage is really it's a genuine potential game changer, and we think that battery storage is really a key ingredient from that transition from, the old way of doing things, which is that centralised grid that is heavily reliant on fossil fuels, to the new sort of paradigm, which is a decentralised world and low emissions. And the third theme I would mention is the changing business models that we're seeing amongst companies throughout the market as they try and adapt to those changing dynamics. And look, I'm really pleased to be here today, and I'm looking forward to drilling into those themes a little bit deeper as we progress through the panel.
Thank you, Anthony. And Joseph?
Sure. First of all, I'm going to assume that most of you know what...
Can't hear you. Why don't you hold that up a little bit closer?
I'm going to assume that most of you know what Citigroup does. All right, that one's not working. Okay. But I will say one thing, that the firm's global power business has been a really instrumental part of Citi meeting a commitment to $100 billion of capital outlaid and financing arranged in sustainable energy investments. I'm going to spend more of my discussion on the U.S. business, although I think if you looked at the U.S., compared it to the rest of the world, particularly Europe, you would find the direction was the same. The problems may be similar, the solutions may not be identical. And if you like understanding why all the finance types like the power industry, let's get a few snippets here. At the year end of 2018, the rate base in the top 20 companies in the U.S. power sector was just under $600 billion. And if you looked at projections of industry capital requirements going forward, in the U.S., they would be well in excess of $100 billion. If you then looked at capital expended on clean energy over the last decade, you would find that to be just under $550 billion, and around $40 billion forecasted on a going forward basis. So if you added those two numbers and did what I describe as vice chairman math, you'd say that was somewhere around $150 billion of annual capital, which explains why banks and financiers like the sector so much. Second point I would make is that the utility companies in the US have really responded to changes in customer preferences, regulatory preferences, and environmental preferences. If you looked a decade ago, you would find that 40 to 50% of the capital expenditures was spent on generation. And those were big bets, and they would have ranged from coal to gas to a couple of intrepid folks on the nuclear side. Now, if you looked at that today, that same capital allocation is about 20%, and it's forecasted to go down to somewhere between 10 and 15% in 2 to 3 years. That money spent on the transmission and distribution business over that same time period has kind of roughly averaged 45% plus or minus a bit. It's projected to end up at over 50% by 2020, which again would be consistent with a phase out of less capital into generation, much more into customer businesses. The other big change has been that electric companies have entered the gas infrastructure space. And a decade ago, roughly 10% of the capital expenditures would have been in that space. Now it's somewhere approaching 25%. In addition to those dollars, in round numbers, $6 to $7 billion have been spent on energy efficiency, and that would include things like energy efficiency service contracts. And that's an amount of capital continued to be expended. When we talk to the utility management teams, the biggest question they have is really affordability. Because if you think about this, the top 20 companies, let's call it, have $600 billion of capital. In 5 years, the whole space is going to essentially rebuild the rate base that those companies have. And the electric sector has done a great job at keeping costs constant in the US. If you look over a long period of time, the real price of electricity to customers is flat on an inflation-adjusted basis. The problem is demand for the product is going down. And the real issue, I think, most of the companies we deal with is, yes, we have to spend this capital for reliance and for transformation. But if demand for the product continues to edge down, what will we be able to do in terms of maintaining affordability? And that has been, I think, one of the biggest questions that companies have had. And to put that in another context, we would expect that the capital committed going forward is going to be committed probably some in partnership by the utilities, others in partnership by the private markets. Because if you think about the capital, renewables, battery storage, those kind of matters, energy efficiency can be rate-based, they can be outsourced. And I think it will become a question of which is most economic for customers. And if you wanted a snapshot of that, currently the wind energy capacity in the US is about 85% in the hands of private parties, about 15% rate-based in utilities. On solar, it's 95.5. And on storage, albeit a tiny, tiny sample, on a megawatt basis, it's about 50-50. But I think that's, again, a very tiny sample, and that's on megawatts. And if you also said, well, how does this get financed? The public companies in the US sector have had extraordinary access to capital. PE multiples are now, if they're not at all-time highs, they're close to at all-time highs. And I would say the US industry is in a very different spot than, let's say, Europe, where the average US big cap utility trades at a PE multiple of about 18.5. In Europe, that same number is about 13.5. And the cost of funding is also incredibly competitive, with most companies able to borrow in the 10-year range at 4%, something 4.5%. On the private side, there's roughly $2 trillion of dry capital available to invest across private equity in these sectors. And about 90% of that would qualify for infrastructure-like, which is where this money pot, this sort of capital, that capital finds these types of returns and risk profiles. We estimate that, in 15 years, about $1 trillion will be invested in the renewable space by private capital providers.
See, that's what happens when you get smart people up here. You don't have to do anything. They just they kind of roll with it. But I do want to piggyback off of something. And Lawrence, please let me know when it's time to turn it over, because I know the audience, I want to make sure they have questions and get them answered. But I do want to follow up with Carolyn, because both Anthony and Joseph both indicated, the changes that they're seeing in financing the grid infrastructure. From your vantage point, talk about that. So over the next 5 years, what are some of the biggest changes you're seeing in going after this? And then please, Anthony, Joseph, elaborate if you want to add something to that.
So there are two big changes we see in relation to financing. One is the digitalization of meters and monitoring of usage and so forth. That's allowing us to go out to a customer base that isn't well off or middle class. There is an initiative called Energy for Everybody, and we had to make 200,000 connections in Ivory Coast to areas that didn't have access, and we're already at 140,000. We have another year to go, but that's going very well. The second thing I would say is e-banking. For us, it isn't going to be about paper mailing and getting back a check in the mail. The last speaker said it very well. We're not in that world. We're in the world where everybody's going to be mobile payment. It's going to be mobile payments. So that's going to be very helpful in terms of collections. So monitoring and collections means a much more efficient utility for us. And in terms of our own capital and financing, we made a run up to an IPO on the Euronext and regional exchange. We had outside, let's say, exogenous factors that had nothing to do with our company that made us decide not to do it at the time. But we have financial and strategic players just chomping at the bit to invest in our model and our whole construct that we've come up with. So, yeah.
Anthony, Joseph, anything you'd like to add to that?
Yeah, sure. Thanks, Calvin. Look, I'm going to answer this one again from the standpoint of an infrastructure fund lens of the world. Look, the biggest changes I think that I've noticed over the past 5 to 10 years is the investment universe for funds, like ourselves and our competitors, I think has broadened significantly. 5 to 10 years ago, within the power and utilities space, we'd probably have appetite only for the likes of regulated utility businesses that are very stable, perhaps some long-term contracted renewables assets. But what I'd say is the universe has broadened, as I say, and we're more and more looking for businesses with, some more operating risk and upside, growth platforms, and as I mentioned, businesses that really are sort of leading-edge technology businesses, so that we can really invest in some of that potential growth. And we also see it as a potential hedge against, some of the more traditional businesses that I mentioned that are experiencing pressure. Because as Joe mentioned, you see the likes of utilities, particularly across many markets of the US, are grappling with not just flatlining demand, but falling demand. So that's the biggest change, I would say, a broader universe and a more open mind in terms of where we put our capital.
The only comment I would make is I think across the U.S. industry, there is a clear imperative to invest in technology. And most of the companies we deal with are doing the very difficult calculus. If I invest in technology, I earn on the technology. I put it in rate base, I earn on it, but that costs money. And then how do I, in a vaguely flattish to slightly increasing customer rate environment, what do I then have to do on the traditional cost side of my business to pay for that?
So Joseph, can we take that a step further? On that investments, the technology, we know whatever I install today can be obsolete in 2 years, if that long. And from a utility perspective, I usually like that 20, 25, 30-year run. How does that financing work, and what are we going to do about that?
Well, I think today most of the assets financed by the sector have been long-term assets, and they've been part of a broad regulatory agreement that says you're going to recover these over 20 to 30 years because they have that kind of life. I think some of these investments, the companies are going to have to go to the regulators and say, look, this is a 5-year investment, and we need to recover the costs in 5 years.
Okay.
So that will be one thing. And secondly, the time involved in putting them into rate base, earning on them, I think you will see companies increasingly say, all right, let's do a regulatory arrangement that lets me invest and phase that in so that the rate path for my customers is more gentle.
Okay, so let's keep on that to all of you. It's a room full of regulators. All right, so you have regulators in here. What single issue would you ask them to prioritize in their thinking about the necessary conditions for incentivizing the investment in the grid of the future?
I think it's structuring the rate arrangements in such a way that companies are incentivized to use best available technology and take advantage of those opportunities, and not worry if, let's say, demand for product, i.e. electricity sold, goes from here to there. So I think a decoupling mechanism is very valuable, and looking at the infrastructure essentially as similar to a demand charge in a power purchase contract is another way of thinking about it. Okay. Because I think you have to break the incentive to sell more product from the incentive to provide the proper infrastructure.
Yeah, sure. Look, I think my sort of one and single message for regulators would be that regulation needs to be designed to nurture and support the tools that we need to facilitate the transition that we're talking about to this, low carbon and decentralized world. I think one example that I just mentioned there is it's relevant to the nascent but growing industry of energy storage. There are still in existence some pretty serious regulatory impediments, I think, to the broader rollout to energy storage, particularly on the grid side. And there needs to be more products, I think, that really value the fast ramping characteristics and therefore the grid stabilizing features of batteries to really unlock the potential of batteries on a wider scale. There's been a little bit of progress, I think, in PJM and California and other developed markets such as those. But as I say, I think that more needs to be done on a more widespread scale.
So, Carolyn, I'm going to give you that last question, but I was struck by one of your comments about what you're doing on ePay. However, in Maryland, we couldn't even get them to waive fees for credit cards. So that's just an interesting dynamic when you're dealing with regulators. What would be your one message?
Yeah, well, it's interesting because we have the opposite dynamic of my panel colleagues. We have booming demand, right? The continent needs 70,000 megawatts and maybe has 10,000 available. So it's a little different rubric. The other thing I would say is our partnership with the government really relies on them to maintain the grid, the transmission infrastructure. So we are looking at renewables such as solar for remote areas, but that has to be in a good partnership with the government for that reason as well. But they really want us to reach these regions that don't have electrification. So we have an incentive to find out how to do that cheaply and cost effectively so that it's affordable. That's the thing we've had to crack, and we believe we have with this program, Electricity for All. And then when we do that for them, they have access to the 20-year capital for the grid. So it's such a strong partnership. And again, I'm wondering, I did make the last speaker's talk, but I think I might be in that part of the timeline for humanity in Africa. That's really what you're seeing. They're thinking with fresh eyes and fresh prospects about solutions.
So keep diving down that path with us. Is that you're headquartered here in D.C. and your company? Am I correct?
Yeah, I mean, we have we were founded here, and then we have a Paris office and 4 offices on the continent.
So walk us through the process of saying, we're going to go invest in Africa.
Right.
The why?
Sure. Great. So the thesis in Africa for decades had been aid, right? Let's give them aid and try to help them with aid sorts of dollars. And after several other regional funds had been formed in emerging markets by AIG, together with world leaders, every one of the AIG emerging markets funds had Lloyd Benson or Henry Kissinger or somebody. The Hank Greenberg said, hey, well, let's do this for Africa. Why should Africa be any different? And my partners and I had all been doing business in other regions of the world, myself in Eastern Europe. So he reached out to Nelson Mandela and said, we'll raise capital for this, and we're going to show you can make private sector returns in an honest way in Africa. Hey, that's new. And we raised $400 million. So, but we had to prove up this thesis then that was 3 times your money, 25 to 30% internal rate of return on these funds that look just like the funds in the rest of the world over a 5 to 7 year period. And we had no idea if we could really do it, but we put all the best practices to bear. The governments, many of them were in great shape. They had stable budget deficits, gotten their public finances in order, lower levels of debt than the United States by a large margin. That's changing a little bit now, but so it went really well. And our initial thesis was infrastructure because we thought that was where the greatest demand was, but then we added financial services, and then tech-enabled businesses and consumer retail. Along the way, you want to pick really good companies to prove this thesis up because you want to succeed. It was sort of a critical mission. And we raised money from European pension funds, of course, development finance institutions, but only 40% of our money came from these multilateral sources. The rest came. El Paso Energy Trading, I don't know if anybody was ever related to that company, gave us a very large investment to do this. And we happened upon Aeronova as an example of a business we thought with the right financial structure and the right backing could be a really good story. And it turned out that was true.
Joseph, you look like you wanted to add something there. You good? Okay. So I want to turn to Anthony. You mentioned in your opening statements about your partnership, our investment in Invernergy. Yep. So when you saw the topic today, the mitigating, tell me about that partnership and the formation of that and how it applies to what we're talking about.
Yeah, sure. Thanks, Calvin. Look, the Invernergy, the investment, I should say, that Calvin's talking about is a 50-50 joint venture with Invernergy Clean Power. We closed that investment in August last year. And Invernergy is one of the leading independent power producers in the market here. And the investment, the nature of the investment is a investment into a 3.5 gigawatt operating portfolio of gas-fired power stations across North America, as well as a pretty significant early to mid-stage development pipeline. So look, let me sort of tackle that question by painting a little bit of a picture around thematics, and I touched on this in my opening, and that's in 2018 there was actually 15 gigawatts of coal-fired capacity that was retired here in the US. And in just the first couple of months in 2019, there's been an additional 2 gigawatts, I should say, of capacity retired. So that's 17 gigawatts retired in the space of about 14 months on a base of, I think it's around 250 gigawatts in total. So we're talking very significant numbers in terms of retirements of coal, both in absolute megawatt terms and in percentage terms. But the question, I guess, that a lot of sort of market watchers have on the mind is what's plugging the gap. And the gap is being plugged in the US anyway by new gas-fired generation and by renewables, and particularly wind. And that really kind of sums up a lot of the thesis behind our thinking behind that joint venture that we formed with Invenergy. The fact that there's such significant retirements, we think, is creating some really good opportunities for gas as a transition fuel. As people may be aware, gas is 50 to 60% lower CO2 emissions than an otherwise equivalent coal-fired power station. And we think it's really a stepping stone as we move from sort of the old world that I mentioned to the new decentralized and lower carbon world. So that really underpinned a lot of the thesis behind that investment. I think in terms of mitigating risks, the fact that we've partnered with a true sort of blue chip partner goes a long way to managing risks. And in terms of maximising opportunity, I'd point to that thesis around coal retirements and the importance of gas as a transition fuel, as well as the development pipeline that I mentioned that gives us a lot of levers to identify and capitalise opportunities as they arise.
Thank you. So, Joseph, you mentioned, and there's so much discussion around electrification of our industry, the decarbonization and so forth. Where should utilities be investing in the future? What would you recommend?
Well, first of all, I think utilities in the U.S. are not homogenous companies. And I think that's an important point. I mean, Exelon is a different company than Edison International. And Exelon subsidiaries can be different companies from each other. So I think to some extent, the investment opportunities and where they should be investing is a function of the business model. And that's largely a function of state regulation. But I think you will find in general, US utilities will be investing, one, in technology that will augment the customer interface and provide information and data that they can use to better run their systems and better interface with their customers and provide, in effect, better service. So I think all companies will be doing that. Secondly, I think companies will be transitioning a generation fleet from coal into natural gas into renewables. The speed of that transition, I think, will be a function of where the company is located, the composition of its fleet, and the local political and regulatory environment they operate in. So that will be another source of investment. And I think that the other piece will be essentially making sure that the T&D business itself is highly reliant and also up-to-date and sophisticated. And I believe there will be lots of investment in technology interfaces so that people can use their cell phones and those kind of matters. I think the big risk for the companies is you put all of this money into the system, you need to find a way to earn on it. And one, what's the rest of your cost structure like? And then secondly, in a state like California, you have the formation of these community choice aggregators who then have an ability to, customers are going to drop off the PG&E system. What happens to those stranded? What happens to that investment PG&E has made?
That's right. So thank you, panelists. So I want to give before I ask any more, I want to give the audience an opportunity to sit back and ask questions of our panel if you have any questions. Anyone? I knew David would. David, and then we'll go there. Yes, sir.
If I could take up what Joe was saying, that was very prophetic, Joe. So you spoke about the changing business model. Should there be a different way that we attract capital? The rate-based, rate of return approach has served us well. Companies are seeking now to go behind the meter, provide a broad array of services. That's a service model. That's not a rate-based rate of return model. So should the approaches that we use to attract capital change? And if so, what should they be?
Gee, I said I wasn't clear that I wanted to be the person that got the David Owens question.
That's why I went to you first, David.
Look, I think, first of all, you have to look at infrastructure itself and how the infrastructure is paid for and compensated. I think, David, it's almost less of a question of how the capital is attracted than it is of what's the business and operating model for the company, and then what's the regulatory model attached to that. I think you could easily see infrastructure itself being something that looked like a demand charge. And if you look at Texas, for example, those companies don't control the customers. The customers are controlled by the retailers, and the infrastructure, in effect, is paid for in a demand charge, or something similar to that by the retailers. And secondly, it may well be that the customer interface the information won't be a utility-owned asset. It may be an asset that's a partnered asset. Because if you think about it, there are companies who are already in these homes. Google, Amazon, Apple, with more money than God, and with technological expertise that the utility companies really can't replicate, and who absolutely do not want to be regulated. So I would suspect some of that customer data information, that customer interface, that may well be something that ends up being partnered. And how that's financed then I think is less certain, but that's also a distinct possibility.
Anthony, Carol, anything to add?
Yeah, look, I'll add a couple of thoughts. And I noticed David mentioned behind the meter initiatives and challenges in his question. Look, that's an area that we've been spending a bit of time on at AMP Capital. It's interesting to note that certain markets across the US and Canada, there's scores of large industrial users that are paying, I think it's up to almost 3/4 of their annual electricity charges in the form of grid demand charges. So look, with that kind of sort of construct, there's, we think, huge latent value behind the meter from initiatives like batteries that can be installed to operate as peak shavers, and also demand response initiatives, for potential new revenue streams for these industrial users. And I think the point I'd add, and I believe it's really echoing Joseph's sentiments, is that it's perhaps not immediately clear how some of this will be financed, but for initiatives and for technologies that solve problems and really create value, like what I'm speaking about, capital will be there.
I was just going to add that it isn't so remote for us, the bundling of services. You already have bundling going on all over Africa, and so of course we're free to think outside the box a bit and work with tech companies on our solutions, and that's exactly what we are doing as well. So, and then the savings that we have proven up on the to industrial customers, we're able to use to have more investment in other solutions. So, I think it's on the right track.
Thank you. Yes, sir.
Hi, I'm Elliot Roseman with the United States Energy Association. In the same vein, I'd like to ask about the word affordability, Joe, which you used a little while ago. There's many people who are really kind of on the edge with regard to their ability to afford electricity right now. During the government shutdown here a few months ago, we found there were a lot of people, a high percentage of Americans that had maybe $400 or so in savings. I mean, increases in power costs and utility costs and heating costs, et cetera, are meaningful for them. It's great to think about sort of changing the rate structure, but what do you do for a lot of people, and in developing countries as well, who really have challenges in sort of meeting their monthly rates? And if there are more demand charges, then there's more of a fixed cost, and it's more difficult, potentially for them to pay. Can those rate increases be offset by more energy efficiency, with a couple $1 trillion being invested, I don't see how you avoid the upward pressure on rates, and won't you leave some people behind?
Well, look, I think all of the companies, as they're looking at their capital expenditure programs, are really cognizant of what the cost of the programs is. And they are looking for ways to operate their business more efficiently so that they can mitigate the customer impact. If you talk to the CEOs of companies and you ask them what's the most important factor, a good percentage of the time they will tell you the number of their customers that are at or just about the poverty line. So the companies are cognizant of that, and they are trying to work on costs and rate structures to mitigate that. I mean, Baltimore would be a really good example.
It's a great example. And I would sit back as a utility exec, I would tell you that we do not create a capital investment plan without rolling in the affordability discussion within there, because we know we have to lead with that and explain very clearly the customer benefits that are going to be derived and what we are doing to offset something on the other side. And the challenge with being the first gas utility is we have an old infrastructure. So we have to take care of that. But then the next question from the commission is, what else are you doing to offset? And that's real for us, and we continue to balance that. And we've been very fortunate because the commodity price continues to go down, so we've been able to balance that. You know, we tell people all the time that the price that a customer is paying for energy today is the same or less than they were paying a decade ago. So that helps us, but that comes to a head, and you have to balance it. Please.
I don't know if you're going to like my answer, but we came up with two ideas. One was a technical innovation where we allow some prepayments, and that also reduced the cost because we had certainty of payment and we could finance off the back end. The second thing was sort of a financial mechanism where we actually extend credit to those that are doing well on their payments. And then we have a fund where some of our profit goes into a fund that we then use to help with some cases that are not doing well.
The other thing I would say that the industry has done, when you run balance sheets that are as large as these companies, they are very, very cognizant of refinancing opportunities, cost efficiencies. If one of the big benefits the sector has had over the last decade is they essentially have refinanced their balance sheets. And they have taken them what might have been 6% or 7% financing down to 3 to 4% financing. They've benefited from the gas. And the other point, I think, is that most of the benefits, or a great majority of the benefits of tax reform for this sector were passed through to customers.
They were. And I would you talk about the regulators in the conversation. We just were allowed to do a pilot on prepay, very similar to the back in the day when people were doing their cell phones. So helping with our energy efficiency programs and prepay, seeing how customers really changing behaviors and making them think of their energy usage like any other household product. And we're trying to get that movement going. Sir, you had a question, yes. Mike behind you.
Yes, my name is Lamin Savadogo with Marathon Energy Systems. We have several African utility executives in the room, and Africa is by far the less electrified continent in the world. You were talking about sluggish growth rates in the US. The growth rate in Africa is explosive, 10% in many countries. I have two questions. One to Carolyn. Are Ivory Coast and Senegal unicorns so that those investments cannot be repeated? That's why people are not rushing to Africa. We get a lot of mixed messages from the US capital market. Last year, Blackstone, which had promised to invest about $2 billion in Africa in infrastructure, withdrew. Okay, about a month ago, the Financial Times, the Economist, the venerable Economist, wrote an article in which it said, I quote, "Getting a power connection to the poorest of the poor may be the wrong priority for a government." Okay, and then lastly, last week, the government of Ghana issued Euro bonds. They were looking for about $3 billion. The offers were more than 6 times. So, which is it? You know, Ivory Coast and Senegal unicorns, and what about the big guys? Financial Citibank. You are a global financial company. You have networks everywhere. Great analytical capacities. So what is it that doesn't attract interest to these big numbers in Africa? Thank you.
Hey man, I like the David question. That's
I thank you for your question because I feel like I could have planted that myself. It's a fantastic question for me in particular. No, they're not unicorns, but that's with the caveat of everything else I said, which is you need a real commitment to a country and you need a domestic element, both financial and technical. It can't be, I'm not going to, well, I will, AES, we're in, we're out, or, BWIG, we're in, we're out. You need to be committed because you have to develop a relationship with a regulator who by definition is not Baltimore, right? It's something new. We have projects, our whole platform company, the basis of our IPO was not really for Cote d'Ivoire and Senegal, it was the future growth. The other unicorns we're identifying where we can see depth of management and we can see a regulator who has a history of stability. So we have 4 hydro projects, Madagascar, 2 in Gabon, and 1 in Mali. We're looking at biomass, cocoa and cashews. Solar is soon to come, I think, if we can crack the cost revenue, see where the margin could potentially come from to make investment interesting. And wind, it depends on the country studies. But you have South Africa did a very good tender that was very successful, and there are other private equity players like Denham Capital, similar in size to us. I don't want to say we were different, we were better, we were great, but I think Blackstone may be charging in without really getting ready for what it was going to be like, may not have had all those factors in mind. I think KKR may have done the same thing, and a few other big people, and in fact, we write about it all the time. They almost did more damage announcing they were coming in and then withdrawing than had they not done that. Another big impediment, though, is on the banking sector. It's very hard to find a correspondent bank if you're an African bank now. Banking is just, the solutions will be local. Just like in the US, private banking has taken off, and that's really where it's at in many senses. I think you're going to see that in Africa as well. But the big nut that hasn't been cracked is North American pension fund capital. It's the biggest in the world, and it's not there yet, but it will be in 5 years. I believe that. So,
yeah, I would simply say that Citi has quite significant business operations across Africa, and they range from financing enterprises and projects to basically doing, I would describe it as infrastructure business, which means moving money largely for big multinationals around the world. And we have a significant business, we have a commitment, and we have a significant emerging markets commitment. And I think a situation like the Republic of Ghana, to some extent, if you like the country, and you like the business opportunity, there are finite fixed income opportunities, for example, and Ghana would have probably, I can't comment on that, would have probably been pretty attractive. The yield would have been attractive. And you'd be surprised. I mean, we were one of the leaders on the Saudi Aramco transaction, and I think that 95% of the fixed income managers in the world probably put in orders for that transaction. So I think there's a supply and demand, and there's also, among funds, there's an imperative to invest in emerging markets. If you're an emerging market fund, there are only so many opportunities that you think are attractive that have the returns that you believe that are proper.
Ladies and gentlemen, Gus. Yeah.
Thought I got out of that. No, look. So AMP Capital, we're predominantly a OECD-focused investor, and our pools of capital are predominantly OECD focused. So the fact of the matter is, unfortunately, we're not in Africa today. But listening to some of Carolyn's comments, it makes me think that we should be. I think part of the the response or the reason for that is we're loath to dive into assets, markets, jurisdictions, whatever you want to call it, that we don't feel we have, the requisite expertise, knowledge, and experience, or some sort of unique angle. And today, we don't have that in Africa. But as I say never, and let's hope that in the not too distant future we do have that expertise, and we are putting money to work in the region.
Hey, Anthony, did you say in your intro that you have a relationship with Bith Energy?
No,
you didn't say Bith. Okay. So first off, I hope everyone in the room found this conversation informative. Please join me in thanking our panelists for their time this afternoon.